So yes, you can be a profitable trader. So just decided to put together what I call the simple swing trading system. It should give you a steady 7 to 10% return a year. There's no need for fundamental research because frankly it's really boring and don't really do any technical analysis, because I guess this is my personal belief, but technical analysis is overrated, and this system takes only 15 minutes a day to run. The beginning of the market, you might have to look at your positions or enter a new position or exit a new position, and the next time you might look at it on the same day as at the close of the market. Now, the first part of the system is finding the market trend. And what we do here is we go into Google and just look for any of the major indices. Now, indices are, you could describe them as a basket of stocks, a basket containing stocks. So the Nasdaq 100 contains what's known as the 100 largest tech companies. Another indices would be the S&P 500 or the Dow 30. They're just really a basket of stocks. Now, if you run up any of those indices, here we've got the Nasdaq 100. Just have a look at the price change over 6 months, over the most recent 6 months. And right now, as I'm looking at it in October 2023, it's over the 6 month period, it's up. So we can say that, and I like to think of it like a wave. The big wave is the 6 month wave. So we can say that the 6 month big wave trend is up. So generally speaking, if the value today is higher than 6 months ago, it means you are pretty much only looking to buy. If the reverse was true, then we'd be looking for stocks to sell short. And that's generally it to do with the market trend. So when it comes to picking a stock to trade, you can pick any of the stocks in the indices, because generally speaking, these are the biggest companies. We're only looking to hold a position anything between 3 days to 6 months, and the likelihood of those companies tanking or something nefarious happening is negligible. And the other reason is that these are the companies that the large institutions tend to invest in. So we want to follow the big money. I call them the elephants. We want to follow the herd of elephants that are investing in these larger companies. So we want to ride the waves in any direction. If the elephants are leaving and taking their money out, we want to be shorting. And if the elephants are buying and the general market is moving up, we want to buy positions. So you don't really want to overthink all of this with boring fundamental research and technical research. A lot of the technical indicators or even the fundamental research, they practice what I call fortune teller, the type of projection into the future. No one can really tell the future, but it's all in an effort to reduce risk. But using a lot of these indicators, it actually exposes one of the, it's called a judgmental heuristic. So it's things that we have innately in us as human beings, that they're good for survival, but in the environment of trading and investing, it's not really helpful. So in survival, it's good for us to look at patterns and rhythms say we're hunting, there are certain patterns, or following tracking an animal. So in survival, looking for patterns is a good thing. But in terms of the markets and what might happen tomorrow, 6 months ahead, a year ahead, you just don't know. And you can't really use the same survival mechanism to um, give you surety or security. So really, a lot of the fundamental research and technical analysis, I mean, they can be good, but I feel like they're a psychological trap. So what we use, one of the tools we use is called the average true range, and this is a measure of the volatility of the average price movement of a stock or an instrument. And we'll be using it 3 times in this system, so it is very important. The average true range that we use is called the 14-day average true range, 14-day ATR, and this is the average price movement of that stock taken as an average of 14 days. So we're going to be using that 3 times in the system. So the first way that we use the average true range is in setting what's called a stop loss. Your stop loss is that part of your system when you take a position. Your stop loss is at which price are you going to get out, at which price is the idea you have isn't working. So if you're buying, at what price are you going to sell it? And if you've gone short, at which price are you going to buy it back so that you limit your risk? And what we do is when we decide to take a position, we take the average true range, which you can just find in Google, the 14-day average true range of the stock. Just type in 14-day average true range and the name of the stock or the ticker symbol, and you multiply that average true range by 1.6. And what we call this now the stop loss value. So this is the level. This is, if we're buying, we multiply the 14-day average true range by 1.6, and this becomes the price at which we sell if our idea is wrong. And if we're going short, the opposite is true. We set our stop loss at the height of the day, and then we multiply the 14-day ATR by 1.6, and the stop loss is that much higher. So that's the first use of the stop loss. And how about how many shares to buy? Okay, well, what most people will do is, let's say they have £10,000. What they'll do is they'll say, oh, I'm going to diversify. I'm going to pick 10 stocks, and I'm going to put 1,000. I'm going to use 1,000 to buy each one of those 10 stocks. So they'll invest £1,000 10 times in 10 different stocks, and to them that's like a diversifying. But one of the buying models I adopted, I learned from a guy known as Dr. Van K. Tharp, and he promoted the use of the percent risk model. So you take 1% risk of your total account. So if it's 100,000, that 1% risk is £1,000. And then what we're going to do is we're going to take that £1,000, that's our risk, and then we're going to divide it by that stop loss amount that we calculated earlier, and that's going to give us the amount of shares to buy. So if your SLV is 1,000 divided by 1 gives you 1,000 shares to buy of that stock or that instrument. So imagine you've done that across so imagine you've picked maybe 6 stocks. So you've taken 1% risk of your £100,000. So you've done 6 separate trades. So that means your total portfolio risk is now 6% of your total account, because you've risked 1,000 with one stock and you've done it 6 times with 5 other stocks. That's the amount of risk I would recommend at any one time. Is I would tend to have 6 open positions maximum, because so it means your worst case scenario is if all the positions go against you, you've only lost 6% of your account and you're still in the game. Now, if you're a little more aggressive, some people would move to have 10 positions, so their total portfolio risk is 10%. But you have to ask yourself, can you stomach that? Can you stomach a drawdown in your account of 10%? So that's your choice, but I would recommend 6%. And if our position was to move in our desired direction, then you still want to, because stocks aren't going to move, or pretty much any instrument isn't going to move in a smooth line. It's going to be some up days, some down days, but it's going to generally move in your direction. But you want to give it enough wiggle room so that you're not taken out of the stock movement. So what you want to do is you want to be moving your stop loss, but you want to move it at 3 times the average true range. Okay, so whatever the 14-day average true range is, multiply that by 3, and that's the amount that you follow your stock. You follow behind it, so that you're giving the stock enough wiggle room to go up and down while it's on its way to in your desired direction. And then it might move down and touch your trailing stop. If you have enough patience, you might stop it before, but generally speaking, you just want to follow the position by 3 times the ATR. Most trades are closed within 3 months using this system. So using a 3 times ATR, you might get out a slight profit or a slight loss, but generally speaking, we want to give it enough room to move in our desired direction. And that's pretty much it. This should put you in good stead to make a 7 to 20% return, depending on how aggressive you want to be. Now, this same system is the system that we use with our students, but there are a few more tweaks that we add to the system to not only lower the risk, but to increase the return. So we look at making returns of between 30 to 100% a year, but it takes about 30 days to learn the system and about 90 days to truly master it. So yeah, I mean, you can drop us a line if you want to know more, but in the meantime, just good luck with your trading.